Hey everyone, welcome to Value Add, where we talk about everything related to alternate investing. We've interviewed a number of founders who have built platforms in the real estate space, allowing investors to gain access to different types of real estate investments. Here are some of the biggest insights we gained on the real estate market from those interviews. Welcome to Value Add, your edge in building wealth.
Once you realize that real estate is the best asset class, how do you access real estate investments? The most accessible form would be to invest in a REIT. Public stocks, highly liquid, attractive, except the rates of return from public REITs aren't very good. There's also deal syndications. Typically, they have fairly high fees. If you don't know the managers, there's some risk returns are generally underperforming. And real estate crowdfunders, if a sponsor can't get his deal funded through a private equity fund or friends and family, then they may go to a crowdfunding platform as a last resort. That leaves you with real estate private equity, which are investment managers that have achieved a level of experience both in years and deals done. The larger the private equity fund, the safer that fund will be.
What really changed in commercial real estate is actually the capitalization structures or the cap structure. Because a lot of these investments, they're still performing as far as business plan. Because like rent growth is still strong. There's still really good submarkets with job growth, employment growth, income growth. So like generally the fundamentals are strong. It's really just a capital markets thing, which has changed. Interest rates have gone, let's call it 2 to 6. The real estate's still performing. Rent growth is still great. Business plans executed, quality of life's improving. But it's like, wow, with half the deal being in debt, which now costs us 6 instead of 2, the actual capital structure of this deal is a little bit different.
The last few years have been very strange and bumpy, right? I mean, there's no doubt about it. The catalyst is COVID. Even for what we're dealing with today, it's a little more indirect, but really this is all kind of COVID cascade. COVID was an interesting time for the markets because in the public markets, you saw just straight panic followed by that rapid recovery. In the private markets in real estate, there wasn't as much straight panic because there was this feeling of, okay, we can maybe hold our breath a little bit here and wait till we're on the other side, right? This feels temporary. So certain sectors were hit extremely hard, extremely quickly. They bounced back at different rates. For most types of properties, it was a total disruption, more disruptive than COVID, because interest rates have such a direct relationship to real estate property values. It doesn't happen overnight, but at the end of the day, just like your home, if it costs you more to borrow, it should cost you less to buy because that cost to own it goes up. So when rates go up as quickly as they did, really at an unprecedented pace, it just disrupts the market. People don't want to transact. People don't know what the value of anything is anymore. That was really the story of 2022. We had a banner year in 2021, doubled our transaction volume, doubled revenues, and the beginning of 2022 also very strong. And then as that interest rate spike started to happen, we really pulled back and did less transaction volume. It's just harder to find things that made sense still because you didn't quite know where the new rules of the road were. I think the buying opportunity that 2022 rate changes is going to produce in 2023 is likely a once in a cycle thing. Right now, we're also really focused, as I said, on real estate debt. The flip side of rates increasing for equity values is that it means that your rate of lending has gone up dramatically. So a real estate loan that might have been 7% a year ago is now 12%. So that makes it a very attractive proposition for investors. We're being really selective on the equity side right now, finding things that really make sense at this exact moment, then offering more lending opportunities. That's how we're kind of seeing them.
So real estate and investment homes specifically, there's sort of this very predictable revenue stream, right? It's like you buy it for a certain amount, you have all these operating expenses, and then you have sort of predictable rents that come in every month, and then they grow over time as well. well. So then you can kind of do basic math and you're like, okay, well, here's how much I need to live every month. And then one home equals X dollars of cash flow. And you multiply it across several homes and then give it some time so the rents grow and maybe you pay some monthly more. Boom, you go live on a beach. Then as I started peeling the onion back per se, I think that's where I learned sort of the power of real estate. One of which is like leverage. Like you're able to buy homes, you could get really attractive mortgage terms and rates. Even with the higher interest rate environment, there's still really cool and creative ways that you could leverage mortgages. That's kind of what led to the snowball effect, where existing homes pull out some equity, buy more homes, etc., amongst some of the other tax benefits and things of that nature.
And that's today's value add. If you like today's video, hit the like and subscribe button below. For long-form written content, subscribe to my Substack. Otherwise, follow me on Twitter. See you there.